Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. The Indian stock markets have been on a roller coaster ride lately. The indices have shed nearly 2000 points in the last three trading sessions. In today's video, we will see the reasons behind this massive fall and what it means for our investments going forward. To start with, let us break down the carnage. Let us see the details of the 2000 points fall. Well, the Sensex crash from its high of 82,050 to today's low of 80,050. That is a 200 points nosedive. In just three trading sessions, investors have become poorer by nearly 7 lakh crore rupees. Now, the selling pressure isn't limited to blue chip stocks. Both BSE Midcap and Smallcap indices also have declined more than 1%. Now, let us look at some of the major factors behind this market fall. First and foremost, the alarming trade deficit numbers for November. I will read out those numbers and you will be in a state of shock. The November trade deficit hit an alarming high of $37.5 billion, dollars, up from $27.1 billion dollars just a month ago. Now it has shattered the previous high of $30 billion, dollars, which was reached in October 2023. Imports surged to an all time high of $70 billion, dollars, up from 66.3 billion. Exports declined to 32.1 billion from 39.2 billion dollars. So there was a significant fall in exports and a significant rise in imports. Now this explains the alarmingly high trade deficit. uh, the market had estimated the deficit to be somewhere around 23 billion dollars, but what the actual numbers were at 37.5 billion were exceedingly high than the market estimates. Add to this, gold imports jumped a staggering 332% to $14.86 billion dollars compared to just $3.44 billion dollars last year. Petroleum product exports contracted sharply by 49.7% to $3.72 billion dollars. Let us look at country specific trade impacts. Well, exports to countries like China, US, Bangladesh have significantly come down, but there has been a positive growth in other markets like the UAE, Australia, Italy, Singapore, Malaysia, to name a few. Non petroleum trade and service trade has also poorly performed in the for the month of November 2024. The second reason is global market jitters. Now, the US Dow Jones has plunged for nine consecutive trading sessions. This is its longest losing streak since 1978. Now, this global sell off has spooked Indian investors, triggering a domino effect. Thirdly, all eyes are on the upcoming Federal Reserve decision. Now, a 25 basis point rate cut is expected, but uncertainty remains high. Understand a higher US interest rate makes the emerging markets like India less attractive. So, a lower US rate, a rate cut, is going to have a positive impact on Indian markets. Fourthly, currency pressures have also impacted the indices. Now, the rupee has hit record lows against the US dollar. It has reached 84.94, just 6 paise away from the critical 85 mark. Now, year on year basis, the rupee has depreciated nearly 2% against the dollar. Now, understand this, a weaker rupee triggers foreign outflows and it increases import costs for Indian companies. So, not a very good situation for Indian companies with the rupee weakening. Fifth reason is the FII selling pressure. Now, on Wednesday alone, FIIs have sold equities worth 6,409 crore rupees. Now, this massive sell off has put a downward pressure on the market. The sixth reason is the domestic economic concern. The RBI has recently revised the GDP growth forecast for financial year 2025 down to 6.6% from 7.2%. Add to it rising food prices and supply chain disruptions are fueling inflation worries. As per technical analysis report published in Business Standard, what do the charts say? Well, the Nifty index has breached its immediate support level of 24,500. Key support levels to watch out for: 24,000 and 23,800, and resistance levels of 24,600 and 25,000. Now, what should the investors watch out for? Firstly, watch out for global factors, the US Fed policy outcomes. Now, the US Federal Reserve meeting was scheduled for 17th and 18th December. So, a decision about the rate cut is expected today. Check out for global market trends and oil price movements. On the domestic front, look for December trade data, the quarter three corporate earnings, if there is a rebound, if a recovery will happen in quarter three, after the lackluster quarter two results, is what investors should look out for. And RBI's next move. Now, the RBI monetary policy meeting is scheduled only in February. So, any rate cut that can happen will happen only in February next year. Looking out for FII flow patterns, whether they are buying in the market or selling from the market, or the major volatility indicators, looking for these factors can also prove helpful for investors. What should be the investment strategy going forward? Well, in the short run, avoid aggressive buying. Look out for quality large cap companies and keep cash handy. Liquidity is necessary to take advantage of any buying opportunities. While selecting sectors for investment, look out for defensive sectors which might outperform in the current market. Now, sectors like healthcare, pharma, FMCG, IT are such sectors. Export oriented sectors need careful evaluation. Now, export oriented sectors include electronics, mostly smartphones, textile, engineering products, to name a few. Domestic consumption stories remain strong. So look out for sectors like real estate, finance, especially broking and AMC businesses, consumer durables, lab grown diamond businesses, medical tourism are all sectors which have a potential to perform well in the domestic markets. Risk management is very, very necessary. Now, portfolio diversification is your all weather friend. Secondly, stop loss placement is absolutely necessary, which means setting a predetermined exit price so to limit your potential loss. And thirdly, position sizing is also very important. Now, what it means is determining the number of units of the security to trade based on your risk tolerance and your account size. In conclusion, the recent market fall might seem alarming, but always have a long term outlook of your investments. Any correction is normal in market cycles and they present golden opportunities to enter the market. It is necessary that we stick to our investment goals, diversify, and seek professional advice if we are unsure about our next move. As usual, keep looking for this space for detailed market analysis and insights. And don't forget to like, share, and subscribe to my channel if you have liked my video. Until next time, stay safe. Goodbye.